What's up, everybody? Welcome back to my channel where you subscribe for the best and latest content on investing and business. On September 5th, 2025, S&P 500 futures surged to all-time highs. Investors' optimism over the U.S. economy and corporate earnings drove the market rally. Stocks of tech giants like Apple, Microsoft, and Nvidia led the charge with gains of over 1% each. The Dow Jones Industrial Average rose 372 points, or 1.06%, to close at 35,489. The Nasdaq Composite Index jumped 1.9%, its highest level since November 2021. So let's discuss the key events that happened in the stock market today and what they mean for you as an investor. The S&P 500 futures, which represent the value of the index at a future date, hit a record high of 4,643.50. This is the first time that the S&P 500 futures have reached all-time highs. The previous record was 4,637.60 set on May 10th, 2022. The rally was broad-based, with almost every sector rising. The best-performing sectors were technology, communication services, and consumer discretionary. The worst-performing sectors were energy, materials, and utilities. The market was buoyed by strong corporate earnings reports. Of the 500 companies in the S&P 500, 447 have released their quarterly results so far. About 75% have beaten analysts' estimates, which is above the historical average of 66%. One notable example of a company that exceeded expectations was Tesla. Despite missing revenue estimates, Tesla reported a surprise profit in the second quarter, leading its shares to rise 4.6%. Another company that impressed investors was Nvidia. Nvidia, a provider of artificial intelligence chips, raised its full-year revenue forecast, citing strong demand from data center customers. Its stock soared 2.7%, hitting a new all-time high of 504.97. There are several factors contributing to the market's resilience. One of them is the Federal Reserve's decision to keep interest rates unchanged in July, marking the first pause in its rate hikes since January 2022. Investors are now pricing in a higher chance of a rate cut in 2023 than previously expected. This is because inflation has eased to 3% in June, from a peak of 9.1% in June 2022. Another factor supporting the market is the earnings season. As we mentioned earlier, many companies have reported better than expected results, driven by cost-cutting, inventory reduction, and resilient consumer spending. Analysts expect S&P 500 companies to report a 5.5% year-over-year increase in earnings and a 1.2% increase in revenue, according to Refinitiv data. However, some investors are still cautious about the market's outlook. They point out that the S&P 500 has already risen by 14.7% this year, making it one of the best-performing years on record. They also note that the S&P 500 is trading at a price-to-earnings ratio of 21.1, which is above its 5-year average of 19.4, according to FactSet data. This means that stocks could face some profit-taking or consolidation in the near term. For example, Bank of America said it sees the S&P 500 at 4,600 by year-end. That would be a 1.6% increase from current levels. Goldman Sachs is more optimistic and has a year-end target of 4,900 for the S&P 500. That would be a 6.2% increase. However, Morgan Stanley is more bearish and has a year-end target of 4,500 for the S&P 500. That would be a 1.4% decrease from current levels. Here are 3 takeaways from the recent market performance. No. 1. The S&P 500 has hit all-time highs due to various factors such as the Fed's rate hike pause, the earnings season, and bargain hunting. However, the market's future direction remains uncertain, and investors should exercise caution. Number 2. Stocks of tech giants like Apple, Microsoft, and Nvidia have been driving the market rally as they have benefited from the AI boom and the reopening of the Chinese economy. Apple became the first US company to reach a market cap of $3 trillion. Microsoft is close to becoming the second company to reach a market cap of $4 trillion after Alphabet. Nvidia is one of the biggest gainers of the year, with a return of 224%. No. 3. Investors should consider diversifying their portfolios beyond the tech sector and large-cap stocks, as they may face competition or regulation in the future. They should also look for opportunities in other sectors and asset classes, such as emerging markets, commodities, and bonds. By doing so, they can reduce their exposure to risk and enhance their returns. The stock market has rallied mainly on hopes of lower interest rates and not on strong corporate earnings. While 75% of S&P 500 companies have reported earnings that beat analysts' expectations, their actual results have been below expectations. For example, Tesla reported a surprise profit but missed revenue estimates, and Ford reported a loss that was smaller than expected. Not only that, but Nutting also points out that the Federal Reserve may not cut interest rates as soon as investors hope, that the Fed will likely keep rates unchanged in the near term until it sees more evidence of wage growth slowing and inflation expectations declining. So what does this mean for investors? Well, the stock market could face some headwinds in the coming months, as valuations are likely to decline when interest rates remain higher for longer. Investors to be cautious and avoid chasing returns in overvalued stocks. Instead, they should focus on finding value in cheaper stocks that offer good quality and growth prospects. For example, he doesn't seem to consider the impact of artificial intelligence on stock prices or the potential risks of regulation or competition for tech stocks. Moreover, he doesn't seem to acknowledge that the market has already priced in some bad news, such as the earnings misses or the higher interest rates. In fact, the market has rallied despite those negative factors, which shows that investors are still optimistic about the long-term growth prospects of the economy and the corporate profits. Of course, no one can predict the future of the stock market with certainty, and there are always risks involved in investing. But I think that it's important not to be overly pessimistic or to rely on outdated analysis when making investment decisions. The stock market is constantly evolving and changing, and it's essential to stay informed and adapt to the new trends and technologies that shape the market. Overall, I think that Nutting's warning is a reminder to be cautious and to avoid overvalued stocks. But it shouldn't discourage investors from seeking growth and innovation in the stock market. If you want to learn more about investing strategies and how to build wealth in the stock market, make sure to check out my other videos on my channel. You can also follow me on social media for more updates on investing and business. Thank you for watching this video, and if you enjoyed it, please give it a thumbs up and subscribe to my channel for more great content.